You're very welcome to the Myerson Solicitors Shareholders Agreement webinar for Alderley Park on today, the 18th of June 2020. My name is Andrew Brown. I'm a partner within the corporate commercial team here at Myerson. So yeah, always useful, I think, to put things in context a little. I think the general feeling in the marketplace at the moment is that asset protection is likely to be a common theme for new instructions or work for the professional services sector as we emerge from lockdown. What I mean in terms of when I say asset protection, in terms of the work that we might do, for example, it might be putting a new holding company into a group of companies and transferring assets from trading entities into those holding companies, typically property, real estate, intellectual property, or cash. The idea being that if there's a issue or insolvency issue with the underlying trading entity, then the crown jewels, if you like, are protected in a separate entity. Similarly, you know, it might be that a business has an important trading contract with a customer that's not in writing, and it might be getting that in writing and securing and protecting that trading arrangement. And the important thing to note here is that just like those things are protecting assets, a shareholders agreement is also about asset protection. It's about securing and protecting the shareholder's interest in the shares that shareholder has in the private company. So what is a shareholders agreement, and when is it applicable? Well, it's applicable to private companies limited by shares, companies that trade for the benefit of the shareholders, trade to make a profit, and it's applicable where you have multiple shareholders. So if there's only one shareholder, there's no need for a shareholders agreement because that sole shareholder can effectively do what they want. But it's applicable where there are essentially more than one shareholder. I've got there protects minorities and investors. I suppose if you think of it, for example, if you had a company where there was a 90% shareholder and a 10% shareholder, the 90% shareholder can, you know, with such a controlling interest, 90% shareholder can effectively do whatever they like in those circumstances. And so the 90% shareholder may, in that respect, see no need for a shareholders agreement at all. However, the minority shareholder with a 10% interest will have a different view and would prefer to have a shareholders agreement in place so that their interests can be protected as a minority shareholder. In terms of where you have companies with family shareholders, due to the relationship of family members, typically a shareholders agreement is not required. Sometimes it is, but generally a shareholder agreement wouldn't be required in those circumstances. It's important to note that a shareholders agreement is a private agreement between the shareholders and normally the company as well. Whilst its articles of association, which is the company's constitution, is filed at Companies House and is open to public inspection by the public. And where you are adopting a new shareholders agreement, we would recommend that the company also adopts new articles of association as well. This affords a more robust arrangement. So I'll move on to the next slide. So why have a shareholders agreement? I think the first point to note is that shares in a private company are a particularly illiquid asset. I mean, it's not as if you can go onto your online trading accounts on your phone where you have own shares in publicly listed companies, etc., and literally at a touch of a button turn your shares into cash. You can't do that with a private company. The second point is, I think, here is that generally speaking, if you just fall back on your existing articles, it's likely that those articles would have just been inherited when you purchased the company off the shelf initially. And also, if you don't have any bespoke arrangements, you will just be falling back on the Standard Companies Act 2006 provisions, which can have a random and unpredictable outcome, something that the shareholders hadn't discussed or considered or agreed. Also, of course, a written agreement agreed and discussed between all the shareholders adds clarity and certainty to record of the of the agreed relationship. As you'll see as we go through the slides, a shareholders agreement will touch on a number of different issues, and it will promote the smooth running of the company. For example, in terms of the policy on dividends or directors' loans or making decisions generally. And of course, it will help mitigate against costly and damaging disputes. Shareholders agreement will provide certain procedures to be adopted if there are disputes, particularly deadlock. It will provide what happens when a shareholder leaves the company, what happens to their shares, etc., and how their shares are valued, which I'll come to later. This slide, no money, no need to spend any. Sorry, no problem, no need to spend any money. The point here is that quite often where you have a new startup company, the resources may be there may be many demands for the resources that are available to the shareholders, and a shareholders agreement might not be the first priority. All I would say though is that obviously, and it might well be that the shareholders know each other. They might have worked together previously. They might be friends. There might be a level of trust. They might not see a need for a shareholders agreement. The important point here is that no one has a crystal ball, and the path of the business will inevitably take many twists and turns in the future. So it is important to get a shareholders agreement where one's appropriate in place as soon as possible. So yeah, control. I mean, this is one of the most important things. I think the first question to be asked to the shareholders: how will decisions be made? What level of consent will be required amongst the shareholders to approve certain decisions? For example, you might have a selection of very important decisions, such as borrowing money from the bank. I've got some listed there: commencing litigation against a third party, capital expenditure above a certain threshold, entering into material contracts. Will the consent of all the shareholders be required to make those decisions, or just a majority? Or you could divide certain decisions so that if certain shareholders are operating the business from day to day, then you might say, well, those shareholders can make those day-to-day decisions. But any higher level decisions, for example, putting the company into liquidation, the company selling its business and assets, then those sort of decisions will require higher, perhaps all the shareholders or a higher percentage of the shareholders to make those decisions. And there are other ways of scoping out voting and decision making. You can have chairman can have a casting vote at board meetings where there's an equal amount of votes for and against to make a certain decision. You can have enhanced voting rights in relation to certain identified matters which relate to certain shareholders. It really depends on the arrangements and the shareholders involved. So yeah, deadlock. This would typically be relevant in a situation where you had a company that was owned 50-50, let's say, by two shareholders. Now, obviously, for that company to make any decisions, then both shareholders would need to be in agreement. And typically, you'd have a deadlock where the two shareholders couldn't agree, perhaps on a fundamental issue, perhaps the strategic direction of the company. And then I've got an example there, perhaps an investment in the company by a third party. The point here to note is that disputes can be damaging, and a deadlock clause would provide a mechanism to resolve that deadlock as quickly and as privately as possible. And there are basically three ways you could resolve a deadlock. Either you could create reference to an independent arbitrator who would be referred to in those circumstances, or you could have a mechanism where one shareholder buys out the other. Typical clauses you see are what's called Russian roulette or Texas or Mexican shootout clauses. But the trouble with buyout clauses is they tend to suit the party with the deepest pockets, and deadlocks can be artificially manufactured. So you only tend to see these clauses in commercial joint ventures in reality. Well, thirdly, the company can be wound up. That would only be appropriate where there's no goodwill involved. So that might be applicable to, say, a property investment company where the assets are valued on a net asset basis, for example. The transfer of shares is always a big issue, and This tends to be dealt with in the Articles of Association of the company. But the basic starting company is you wouldn't want shareholders just transferring shares to whoever they chose to. So what you'd normally say, and these are normally called pre-emption rights, is that if anyone wants to transfer shares, then they must either offer, in the first instance, perhaps offer them to the company to be bought back, and then they're cancelled. Or if the company doesn't accept that offer, and it is an offer, then the shares can be offered to the other shareholders pro rata. If those shareholders don't accept the offer, then that shareholder is entitled to perhaps sell those shares to a third party approved by the board of directors. You might also allow, although transfer is restricted in the way I've just described, you might allow shares to be certain proportions of shares to be transferred by shareholders to certain permitted transferees. For example, close family members, family trusts, or where appropriate, group companies. And that's normally done for tax planning reasons, typically. Also note the tag along and drag along rights. Drag along rights would apply, for example, where the majority shareholder, if they wanted to sell to a third party, they could drag all the other minority shareholders into that sale, and albeit all shareholders would sell at the same price per share. A tag along right works the other way. So if a shareholder with a controlling interest wanted to sell to a third party, that third party couldn't purchase the shares unless it made an offer to buy all the minority shareholders out as well. So in other words, it gives the opportunity for those minority shareholders to exit at the same time as the majority shareholder. The compulsory transfers of shares. So these would be applicable where in certain defined circumstances. So if certain events were to occur to a shareholder, then they would be deemed to offer their shares under the pre-emption rights that we just described. So for example, if a shareholder became bankrupt, if a shareholder suffers serious incapacity, serious illness, mental incapacity, serious illness, ceasing to be a director and an employee, perhaps if an employee shareholder ceased to be an employee, you'd want them to offer their shares back at that point. You wouldn't want them leaving and still holding shares. And bear in mind the way the arrangements are drafted is if you had permitted transfer provisions and some shareholders would transfer shares to their spouse or family trusts or whatever, then the way the mechanism works is they're deemed to offer their shares back as well when the original shareholder leaves. So all the holdings are kind of swept up at once when the main shareholder leaves. I've got a bit here on leaver provisions, bad, good, and early leaver provisions. The basic essence of leaver provisions is to scope out, or perhaps in certain circumstances, apply a penalty to the valuation of a shareholder of shares when a shareholder leaves the company. So, for example, if say an employee shareholder was dismissed for gross misconduct, or had committed some fraudulent or dishonest conduct towards the company, they would be deemed a bad leaver, and their shares would be valued at perhaps 50% of market value, or perhaps even nominal value. Of course, and if you're a good leaver, perhaps you're leaving on normal retirement age, etc., then you would receive full fair value for your shares. No penalty would be applied. And I've got their early leaver as well. So, for example, if you were to leave within a certain period of time following the adoption of the arrangements, a penalty would be applied to your the valuation of your shares. Early leaver actually are typical in private equity transactions, where, for example, the private equity shareholder wants to bind in the management team and wants to incentivize them to stay for a period of time after completion. So early leaver provisions in various shapes and sizes are used in those circumstances. Death is also an important consideration. When we were talking about compulsory transfer events before, and yes, you could have death as a compulsory transfer event. So if a shareholder died, their shares are offered back to the other shareholders under the pre-emption rights. But quite often in those circumstances, obviously the shares would pass to the personal representatives, and of course when the shares are offered to the remaining shareholders, it is just an offer. There's no obligation on the remaining shareholders to buy those shares. So the surviving spouse or the personal representative is in a difficult position. One way around that is to have a cross-option agreement. And that would work on the basis that on the death, the personal representatives would have the ability to exercise an option, which once exercised, creates a legally binding obligation for the remaining shareholders to buy those shares. Likewise, the remaining shareholders also have an option that when exercised would create a legally binding obligation for the personal representatives to sell the shares. Now here, prior to death, the shareholder that died would have taken out a life insurance policy, and that life insurance policy would have cashed in, and the proceeds of that policy would finance the purchase of the shares. So that provides quite a good solution, and is a commonly trod path in these circumstances. You can extend it. You can extend it not only death but to critical illness as well. Of course, what I would say is that critical illness policies tend to be very expensive. The premiums tend to be very high, and so quite often the costs are prohibitive. Don't confuse life insurance / cross options with key man insurance. Key man insurance is designed to compensate the company when a key person leaves the company or dies. Share class rights. I think the most important point to note here is that shares bring with them three basic rights for the shareholder. One is the ability to vote. Two is the ability to receive dividends or income. And three is the ability to receive return on capital. And where you create different classes of shares, you can vary those rights to suit the circumstances or to suit the agreed commercial relationship between the shareholders. You can, of course, vary the income right on shares to have differential dividends on different alphabet shares. There were certain tax advantages, well, there still are certain tax advantages of doing that, although they're not as beneficial as they were. Yeah, the next consideration: issue of shares by the company. Obviously, every shareholder would have some concern if the company was to issue further shares, because obviously their shareholding would be diluted by the issue of further shares. So usually, and particularly minority shareholders would want some redress against the company just unilaterally issuing new shares. So you could have preemption rights on the issue of new shares. So in other words, if the company were to issue new shares, those shares would have to be offered to the existing shareholders in the first instance, pro rata to their existing shareholding. You could even go further and say, well, actually, the company can't even issue the shares in the first place without the consent of a certain shareholder threshold. Be careful here, though, where you are restricting the issue of new shares, particularly where you have share options, particularly employee share options. When those share options are exercised, the company will need to issue the shares because it's obviously under contract to issue those shares. So you don't want the director's ability to issue those shares. You don't want that to be restricted. And typically in a shareholders agreement, you can address various other matters, particularly have certain policies in relation to certain matters. Typically, that might be dividends. What level of consent you need for dividends to be declared and paid. You might say that actually a certain percentage of the company's distributable profits will be distributed by dividend each year. It really depends on each circumstance or each business. You might have a policy on the repayment of directors' loans, whether they carry interest, etc. How and when are those directors' loans repaid when the shareholder leaves. You might also have a policy on future funding for the company, whether that be by borrowing from as debt from the bank or by further investment by way of equity. You might also have policies on personal guarantees where shareholders give personal guarantees in support of the company's obligations. If that PG is called in by the bank, should the other shareholders contribute to the liability of that shareholder? You could also tie in a specific business plan into the shareholders agreement, that all the shareholders agree that this is the strategy, this is the path we'll follow. Restrictive covenants are another very important area for shareholders agreements. Where you see restrictive covenants, for example, in employee contracts, courts always look at them very critically because they don't like to restrict or hinder people from earning a living. So in employment contracts, restrictive covenants tend to be restricted in time, geographical scope, etc. But where you have restrictive covenants in a shareholders agreement, you can make those restrictions can be wider, and that's because if you buy out a shareholder, you pay the shareholder for their shares, then essentially you're buying the goodwill from the shareholder. You don't expect that shareholder to then, after they leave the company, set up a competing business nearby or interfere with your customers, your suppliers, and your employees. So restrictive covenants in shareholders agreement can be longer, they can be wider, and they can be more easily enforceable in the courts. Also worth noting that in many private companies, shareholders are also directors of the company, and not always, but commonly. And so that their status as a shareholder and a director will be addressed in the shareholders agreement and the company's articles of association. But also, they may well also be employees as well, and their relationship with the company as an employee is addressed in an employment contract, in a service contract. And so when implementing shareholders agreements and articles, companies urge to think about relationships as employees as well, and implementing service contracts as well in those circumstances. So in conclusion, I would say that every business is different, has different shareholders. It's a different business, and one size doesn't fit all. One company varies tremendously to the next one, the circumstances and the issues involved. And as businesses evolve and change over time, it is advisable to review those shareholders arrangements to make sure that they're consistent with the changes that the company will undergo as it moves forward. So now that takes me to the questions and answers session. You'll see on the Myerson website link, which is very useful blogs and news posts, which are updated as the government come out with further information. And I recommend you have a look at that. We have other social media platforms. Please feel free to subscribe and follow Myerson Solicitors, as we will continue to push out regular updates. And of course, if you need to get in touch with us, by all means, reach out to us. You have our contact details on screen. We now move to the questions and answers. If you can, please populate these within the chat tab found in the icon bar on screen. I can go through and answer as many as I can. I know a few of these have been submitted beforehand, which you will be able to see in the chat tab. Again, as a reminder, this webinar is recorded and will be circulated to you later today. So the first question I've got is, if you own 90% of the company, do you need a shareholders agreement? Yeah, I touched on this earlier. I think it really depends on the negotiating position of the minority shareholder. If the minority shareholder was an investor, then they would have quite a lot. They would have significant a negotiating position and would tend to insist on a shareholders agreement. If that 10% shareholder was an employee, they may not have the same negotiating position. My next question is, how would EMI options impact on a shareholders agreement? EMI options obviously are approved tax efficient employee share options, and typically they tend to be, well, not always, but quite a lot of the time they tend to be exit only options. So in other words, they're only exercisable prior to a sale of the company. So in those circumstances, when the option is actually exercised, the shareholders will get the shares, but then they're immediately sold. So the shareholder will only ever be a shareholder of the company for a split second. So in those circumstances, we've got external options. We all need those drag-along rights that I mentioned, so that you could drag those minority shareholders into the sale. And you want the unrestricted ability to issue shares to those employee shareholders, those option holders, as and when required in the articles. Where the options are based around performance criteria, it may well be that the employee shareholders, when they exercise the options, they fulfill the performance criteria, that they will become shareholders prior to a sale. So you'll need to think about how that impacts on the status quo of those employee shareholders becoming shareholders. And they will, of course, need to sign up to a deed of adherence so that they're bound by the terms of the shareholders agreement. What protections should a minority shareholder seek in a shareholders agreement? It largely depends on the circumstances, but typically a minority shareholder would need protection on the basis that the majority shareholders couldn't change the articles, so that prejudiced the rights on their shares, for example. Minority shareholder would normally look for some protection against, as we discussed earlier, further dilution by the issue of further shares in the company. Minority shareholder would also want access to financial information on demand, so they could monitor their investment, particularly management accounts and that sort of thing, operating statistics. They might even want the right to appoint a director, so that they can sit on the board, they can attend and speak at board meetings, again, as a means to monitor and steer their investment, perhaps. They may also insist on having a veto on certain reserved matters, typically selling the business and assets to a third party, putting the company into liquidation, that sort of thing. And also, in terms of the valuation provisions in the articles, they want to know that when they cease to be a shareholder, on exit, their shares are going to be valued at fair market value, with perhaps by reference also to an independent accountant. How would a shareholders agreement regulate a sale to a third party? Well, again, where the company's selling its business and assets, then that could be a regulated matter which would require a certain level of shareholder consent. And we've talked about where the company's selling shares, drag and tag along provisions, protecting the shareholders in that manner also. Great. Well, that brings me to the end of the seminar. Thanks very much for listening.